Welcome back to the Future Show here on the TD Ameritrade Network. Traders were less than 60 minutes away from the equities cash open here in the U.S. and the 7:30 numbers are out. We're going to take a look here, guys, at the weekless jobless claims and the PPI numbers first before we bring in Alan Nuckman. Let's take a look here because we actually just had PPI, which came in up 0.6% on the month-to-month, and the year-to-year coming in 2.2%. So those numbers here, for the most part, a little bit hot there if you take a look. Now, in addition to the PPI, we actually had jobless claims this morning, which came in at 196,000, so continuing to point to a strong labor market for the most part, which has been and continues to be the pillar of strength. You can see they were estimated at 211,000, and looks like prior got revised to 204,000. So again, with actual, that 4-week moving average coming in at 207,000, prior at 214,000. Again, we continue to be very strong in terms of jobs here in the U.S. Now, traders, I'd like to welcome in the Chief Market Strategist of Agora Financial. We've asked Alan Nuckman to join us here this morning. He was kind enough to accept. Alan, welcome to the Future Show. I want to take a look here.
Good morning to you, Ben.
Good morning to you, sir. I want to take a look here at some of the reaction to the numbers. For the most part, it seems to be kind of limited, although I'm looking at the bonds and the 10-year, which are coming off a little bit. What are you seeing in terms of price activity and reaction to the PPI, the inflation data that just came out?
Seems very muted, and it's obvious. You talked about oil in the last segment. That's been driving prices higher. The big bounce, the snapback attack. But other than that, we haven't seen that spill over into a whole lot of the other markets, especially the commodities are still basing out, shall we say politely, and not a whole lot's happening there.
Alan, let's talk about the FOMC minutes yesterday. Any surprises there? I mean, for the most part, muted reaction, not only the PPI, but we saw that it was a similar situation as far as the minutes and the CPI, the Consumer Price Index inflationary data yesterday as well. Did anything stand out, though, in terms of the minutes for you?
Yeah, the data was limited, but as looking at the FOMC, it was interesting to read, that people still had a free market view. Now, I think that's changing as we get more political with what's happening in the Fed. So I'm concerned that these guys won't be able to execute their findings and their viewpoints. So let's see what happens in the next few minutes and see how their language gets adjusted. And what's really interesting to me is everybody now is willing to give up the free market mechanism of the Fed for politics. But that's for another day. Let's talk about price. Let's talk about opportunity. Let's talk about making money, because that's what we do here.
All right, let's talk about Brexit then, because that's been an opportunity for traders to make money, whether it be for the long or the short side, because it has been creating kind of this roller coaster headline type ups and downs. Recently, we got word that they're going to extend things out until October 31st. Your thoughts on this most recent arrangement? We were wondering which one of those it will be, Alan.
I don't know what it is, but you had a segment on volatility. Now, that excites me. I'm an options guy, and I like talking volatility. Now, currency volatility has been very interesting. If you look at the price action in the British pound, the pound has made this giant wedge consolidation here. We've been trading sideways, but we're reaching to a point of some sort of breakout. Now, we said that a week ago. We said that a month ago. We said that about 2 months ago. So we've been going, essentially sideways. If you look big picture, we're sideways between 125 and 135 since last June. But now we're forming this situation of lower highs and higher lows. Now, coming back to the volatility component, volatility has declined significantly in the last few weeks, and we've actually seen the price action being less than 100 ticks per day in the pound, which is a pretty tight range. So if you look at that spike low in January that we had in the pound at 125, volatility was about 17. Volatility right now is half of that. So, I don't know what that means. I could view that as a positive. But as an options trader, what do you do here? We've been waiting for a breakout, and are we going to wait all the way till October? There are some strategies you can employ that take advantage of this go nowhere fast action that we've been seeing. You could sell a 125 put. Now, only if you want to get into the market at a lower level. That gives you the right to be long at 125. That's down at contract lows. So if you sell that, you're going to take in a handful of ticks here. You're going to take in 30 ticks, so it's $187. So you get paid, this is a June play, you get paid if nothing happens in the next 60 days, and if we're above 125 at that June option expiration, you get to keep that premium. So it's a way to generate a little bit of money, but do not sell cash secured puts unless you want to get into the futures contract at a lower level. So it's a way of getting in at a lower level and putting it, instead of putting in a limit order, you could sell a put as your vehicle to get in and take advantage of what's happening in the marketplace right now.
Yeah, you know, Alan, I'm glad you stressed the don't do it if you don't want the possibility of getting a sign, because again, if we do go lower, if we take out that 124.79 level, you'll be an owner of the British pound at 125 area. But if you don't think that we're going to get below that level, then yes, that's an interesting play. Alan, you mentioned the lack of volatility. I'm wondering, you know, whether it be tied to the FOMC, whether it be tied to the British pound, as you mentioned, as we've been kind of wedging, how much of this is a direct result of the enormity in terms of the transparency that we've seen, again, in terms of our own Fed here and in terms of the negotiation process as far as Brexit. I mean, if we weren't hearing something and a little bit of news every single day, do you think that the market would react a little bit more significantly or more dramatically when we actually did get those little pieces of news?
Gee, I don't know, but I mean, FOMC, you know, they're done. They're not raising rates. You know, we've got the ECB. They're not raising rates. Everybody's taken their toys and gone home. So, you know, it just seems to be, you know, they're not playing, and they're not playing at all this year. And so that's very, I guess that's very transparent. But I think the other component is the fact that the macro market has snapped back and overall macro volatility has decreased. So, you know, you've seen what's happened with oil. You've seen what's happened with, obviously, the stock market come bounding back. And let's remind ourselves, the stock market is 2% away from all-time forever highs again, like nothing happened. So, you know, if we can look big picture, this happened 2014, 2015, 2016. We had 15% sell-offs in the S&P, and they all rebounded and made new higher highs. So this is not, you know, this is not new. But I think this is just a phase that we're in right now, that money flows are looking for still for the stock market to get that yield because of what's happening in treasuries, and there's no payoff right now.
Yeah, there certainly has been. Alan, you mentioned how everybody's taking their toys and they're going home. Well, looks like you brought your bat and ball today, and we're willing to play. We really appreciate that. You joining us here today. Alan Nuckman, the Chief Market Strategist at Agora Financial, helping us take a look at the financials. Thank you, Alan. Reaction to the Fed. And hey, speaking of the reaction to the Fed, I want to dive into a look at the treasuries, which have been